Our topic today is entrepreneurial motivation and management. Free enterprise, which is the ease of business startup and business operations, is the economic basis for all entrepreneurial activity. It's often been cited that the U.S. is a hotbed for free enterprise because our legislation is the most positive for business startups in the world. Free enterprise means that any individual is free to transform an idea into a business, and then therefore creating opportunities, and those opportunities for entrepreneurial startups are then unlimited. We talk about entrepreneurial motivation, we mean the quest for new venture creation, as well as the willingness to sustain that venture in a successful direction. And that's an important issue, is that there's a lot of people that want to start ventures, and they think that they're going to get rich quick, or and make a lot of money and sell their business off or do something like that. And really, the whole entrepreneurial process centers around true entrepreneurial motivation, where you're driven by the passion of the idea, and you're driven to implement that and run a successful business. And in fact, you'll talk or meet several entrepreneurs that might tell you, I love the start. I love the thrill of the start. I get a business started up. I run it until it is stable. And then I either hire other people to run the business for me, or I sell it off and move on to the next thing, because they lose their motivation. Here is a model of entrepreneurial motivation that I actually put together in an article I wrote, but it really talks about the whole systematic process of what goes on in terms of an entrepreneur deciding to take action. And if you look at the beginning of the model here, it is focusing more on the personal characteristics of the individual, the idea they have, their personal goals, the environment, and those types of aspects that create a context for startup. It's not enough just to have an idea. It might be the right people you're working with. It might be the right environment, what's going on in the business community. It might be a personal goal you have, but all those things mix together to affect the decision to behave entrepreneurially. And once you do that, then you start embarking on an entrepreneurial strategy. And the entrepreneurial strategy then is the part where you lay down a business plan in terms of what are the steps, in terms of what is my business model, who are my competitors, what is my market research telling me to and how to design my product or service, and how to deliver it, and how to price it. A financial analysis to assess overall cost and overall revenues to determine whether or not the business is feasible or not. Then we move on to entrepreneurial management, and that is managing the startup and managing the venture. And then the next box is firm outcomes. So then we have outcomes from the venture. It can be money, it can be intrinsic value that I accomplished this, I started it, it's my business. And in the first couple of years, sometimes the intrinsic value of achieving the startup is more rewarding than the extrinsic. And it has to be, because in the first few years, the monetary rewards aren't as high as the satisfaction from the startup. Over time, obviously, that becomes more important. And that relates into the two feedback loops. If you notice, the connection between entrepreneurial management and firm outcomes feeds back to the implementation outcomes perception. In other words, if my management of the business isn't leading to the outcomes I want, then I'm going to alter my decision to behave entrepreneurially or stay in the business. Also, if I look at the actual rewards I get, the intrinsic and extrinsic rewards, if they're not high enough, then at some point I'm going to decide to not behave entrepreneurially anymore. And I've worked with many entrepreneurs who are in that bind where they say, you know, I work on this my business and I'm making $50,000 a year and I left an $80,000 a year job and it's just not motivating for me anymore. And so that's when I tell them that's time to harvest. It's the time to either sell the business, shut it down, liquidate it, whatever the best possible outcome could be. What are the advantages of starting a new venture? In independence, you control your own schedule. While in the early stages, as we've said before, you're going to be very busy. It does provide for outstanding financial opportunities and gains. It allows you to have a business that gets involved in the community, sponsoring events and activities and providing services for them. It can provide job security if you have a successful venture. It allows for employment of family members and also a lot of family businesses, and that's a whole another area of entrepreneurship, truly focuses on succession of passing the business down through different family members and generations. And what I think one of the most important advantages is the challenge, the thrill of the start, the challenge of the start. Some of the disadvantages of starting a new venture include sales fluctuations, whether it's because of the economy, just think back to 2008, or seasonal fluctuations if you're a business in a college town, where your sales go basically dormant through from May to August. Also, there's competition, and you don't always know when your new competition is going to enter in or your current competition is going to heat things up. A good example of that is some folks I know when I lived in Indiana started a coffee shop, a drive-through coffee shop, and was going great guns. But 6 months after they started, a Starbucks moved in across the street. Now you can imagine what happened there. And the reason why it's a great example of disadvantages, but also impacts the planning processes, if they would have gone to the county courthouse and investigated what building permits were being allowed, they would have saw that Starbucks had applied for a building permit to build a coffee shop right across from them. Other disadvantages: increased responsibilities, financial losses, employee relations. That's a big disadvantage because now you have to manage people, and it's very hard. And especially startups tend to employ friends and family. One, because of work for less money, and sometimes they're the only people you can get to help you. But that's a problem because then you got to manage those friends and family, and that there's a lot of problems with that. But even in general, as you hire more people, you have to manage them, give them feedback, assess their performance, and all the other things that go along with managing a human resources base. There's laws and regulations, depending on what industry you're in. If you're in healthcare or industries like that, there is a tremendous amount of regulations you have to deal with, and they're ever changing. But even from the human resource laws that you have to follow to the tax laws and other things, you have to follow them step by step, actually. And there's always the risk of failure. Not every startup makes it. Some industries are more risky than others, like the restaurant and hospitality industry versus other types of production environments and production ideas where you're making a product and selling it. So what is failure? I mean, if we're going to talk about success, we have to also talk about failure. And what we try to do, again, is moderate the risk of failure by teaching how to follow a good entrepreneurial process. But we can define failure as the halt of operations. In most cases, if you're going to stop a business, there's a reason for it. And it's usually low sales or um, some type of bad management, something like that. Some of the causes include incompetence, just the founders can't manage the business, can't manage the financials, unbalanced experience. You haven't brought in enough expertise in the areas that you need to do the business. Lack of managerial experience in terms, not this is not the technical side, but just the people side of the business. Lack of experience in the line. A lot of people come up with really good ideas. They design a prototype. They find some place to manufacture it for them in an outsourcing capacity, and then they go to sell it. Well, they have very limited experience in the production of that item. And so when they need to make changes or when there's quality issues and things like that, it comes back to haunt them. Business neglect. When you start a venture, you have to run the venture. And I've seen entrepreneurs, once they start it, they move on to something else, or they put the wrong people in charge, those types of things, and it just causes the business to fail. And then fraud, where that's intentional deception of how you're using your money for the most case. And a lot of times, entrepreneurs raise a lot of capital, and they see that as a pool of money. And instead of using for the business, they go out and buy things for themselves personally. And so they're defrauding their investors on how that money is used. And then there's also disaster, whether it's a natural disaster of some type like a hurricane or a tornado or flood, or it could be a fire or vandalism and a lot of things like that. But they can, especially in the early stages, can really set a business back. And that's why you obviously need to have really good insurance to protect the assets of the business. When you look at failure data, we can come to two conclusions. Termination rates vary by region of the country, this is in the United States, and also survival rates vary by industry. In terms of new venture survival rate, the most recent statistics show an overall 31% or so survival rate over a 7-year period. So about 1/3 of the startups actually survive at least 7 years. That's a pretty good statistic. When you look at the reasons why ventures fail, if 1/3 of them can survive after 7 years, that's a good amount. Hopefully, with good entrepreneur education and the rise of entrepreneur education programs across the United States, we can see that statistic increase just a little bit. What are some of the new venture management traps to avoid? Things like inadequate records. You've got to keep really good, strong financial records, human resource records, hours worked and payments and hourly rates and things like that. You got to be careful not to expand beyond your resources. While you might start small with one revenue stream, you don't want to start with 5 product lines and under-resource them and then get over your head. We use a concept in entrepreneurship called burn rate, and you want to be very careful. You want to project what your startup costs are going to be and then have at least 6 months to a year, more like a year, of operating capital to back that up before you start, so that you can build a customer base and market your product and grow sales. Another reason is lack of information about customers. You have to know your customers. Hopefully our seminars will provide you information on how to do really good market research and how to get to know your customer better and design and manage your venture from the customer in. Failure to diversify your market. If you're a one-trick pony and you only have one product or service, if your competition comes in and undermines that, then you're going to go out of business. So you got to be careful about that and always scan the environment, look for new opportunities. And sometimes when you move into new opportunities, you let go of old ones. And instead of keeping money being invested in those old ideas as well. Lack of marketing research, getting to know the needs of your customer on a regular basis is critical. Legal issues, if you're not paying your employees properly and you're not paying overtime as mandated by states and by the federal government, for example, you could be ordered to pay back payment penalties, which, when you add it all up, could shut you down because you financially don't have the resources to pay. Nepotism, it's a very common problem in startups because your earliest employees a lot of times are friends and family, but that also has a whole nest of problems as you work to manage those individuals and grow the venture. One person management, as the business grows especially, you can't do it all by yourself, and you have to build a strong team. It's imperative to build a team and bring in skill sets that complement yours and not replicate yours. Lack of technical competence. When you start a venture, you need to start ventures in areas that you have the competence in, the knowledge base in, the expertise that you need, and not get into something that you don't truly understand. It's even more important when you go into a partnership with someone that is highly technical or highly expert in an area and you're not. If you can't get up to speed, you're gonna lose out, and you could be taken advantage of. You could be complying with investments in very, very risky areas. So you need to have that technical competence yourself. And absentee management. You cannot have a venture run itself. A really good example is a restaurant, but it's any venture. When you run a restaurant, if you're not there and your employees are giving away free drinks or putting money aside for themselves, stealing, things like that. But even when you have a high-tech venture, if you're not there managing your people and holding people accountable for meeting goals, developing new products, and giving good feedback to your employees, and making sure your customers are satisfied, even at the more complex side of venture startups, you cannot just put people in charge. You have to manage your venture. When we talk about the types of startups or starting a new venture, two approaches that I talk about a lot are the new approach and the new old approach. The new approach is where new products or services enter the market. So it's all new. There's nothing, you're not building on something else. It's a brand new idea. And some people claim that Facebook was a new approach in terms of social networking. But there's also other previous social networking tools out there, MySpace being one of them, that probably instigated their thought. So it's when we talk about new, there's always some remnants of prior ventures that help start or feed into the project. The new old approach is an individual that piggybacks on someone else's idea. So with the success of Starbucks came many other coffee shops where people said, well, I'm going to start my own coffee shop and I'm going to brew coffee differently. Here in Kansas City, we have a restaurant chain called The Roastery, where they have their own roasting operation and their own coffee shops. And what they're trying to do is do it better than Starbucks and build a different type of client base than Starbucks. That would be a new old approach. The old approach being the concept of coffee shops, the new approach having different types of stores, having different flavors of coffee and different tasting coffees and things like that. And in terms of the financial picture, how do you evaluate the venture? The first thing you want to think about when you're starting up is how much will it cost you to stay in business for the first year? Once you assess the feasibility of an idea, so you're moving past the validation of the idea, you're starting the business plan, it's really important not only to assess the market, but also look at your finances. And you need to be able to do a cost accounting specific enough to look at what will it cost you to stay in business for a year. This includes all your uh, capital equipment, your building and location costs, uh, computer costs, and employee costs. And it might also include other expenses for licensing and certifications and other things. Then you look at how much revenue can we project in a reasonable amount to generate during the first year. And so you compare the two and decide what the risk is you're willing to take. You're hedging your bets by doing really good cost analysis, knowing your market, and coming up with a good implementation plan. But you also need to compare costs versus revenues to assess whether or not to implement the plan. And you may not be able to cover all your costs the first year. And in some more expensive, high tech, or medical type ventures, that's common. And sometimes you project out a 3-year payback. Ventures like Facebook, in terms of profitability, it took a few years before they actually saw profits in their ventures. So you need to make that risk versus reward analysis to decide whether or not you can make money and when you can make money. Then also you need to figure out how much capital I need to raise to get to what we call the break-even point. And that's where your revenues at least meet your cost, if not exceed them. Some other key factors, if you're a location-specific business, you need to really work on finding the best location and testing that location through really good market research. Issues you want to deal with in terms of other financial issues, the merchandising costs, your equipment costs. You want to keep good record keeping. You also, a lot of ventures ignore the issue of insurance and legal costs, and they try to go it alone. You need to build in your cost of doing business and your startup of having good insurance on your physical space and inventory, as well as liability insurance and other protections, so that if something happens that's unexpected, you have the financial protection to stay in business. And then marketing and personnel costs, we've already mentioned that, but personnel costs are the most expensive part of your business for most ventures. And you need to treat it as an inventory and keep an inventory of your personnel. Plan adequately so you're not overstaffed in the beginning, and develop pay practices that allow you to pay bonuses and incentives versus the issue of adding to their base pay. And so they make more money when they sell more or do more, versus if the sales and productivity aren't there, they're not getting pay raises. They're still at their base pay. It helps manage your overall payroll costs, especially in the beginning. One thing you can consider is buying an ongoing venture. I believe that an entrepreneur is someone who starts a business or restarts or reconfigures a business. And they still, if you talk to a lot of entrepreneurs, they still consider themselves an entrepreneur 20, 30 years out. My father was like that. He's had 3 different ventures that are still going after 40 years, now managed by other family members, but he would consider himself still an entrepreneur to this day, even in his 80s. He's still somewhat involved in the business, and I think that is the case when you talk to most entrepreneurs. They're still thinking in an entrepreneurial frame of mind. Some of the advantages, because the enterprise is already in operation, its successful future is likely. I mean, if it's been in business and it's been successful, and you determine that by your due diligence of examining the financials of the business, talking to the people in the business, and talking to customers. Also, other advantages of the time and effort associated with starting a new enterprise are limited or eliminated. Uh, so you don't have to do the full blown ideation, opportunity recognition right away. You take over the business. I would recommend you do that anyway once you take the business over to make sure that you're assessing all possible opportunities for your business. And it's sometimes possible to buy an ongoing business at a bargain price. A lot of times, especially smaller businesses, the entrepreneur is trying to retire. And entrepreneurs generally wait until they're in their 70s, a lot of cases, and then what they want to do is just move on. And if they don't have a family member to take it over, they're willing to sell it at a bargain price just to see it continue on and to gain some revenue out of it instead of trying to liquidate the assets of the business and move on that way. Some key questions to ask if you're buying a business. You've got to figure out why the business is being sold. Is it being sold because people want to retire or they're moving on to another business? So you want to kind of ferret out what it is. If you look at the financials, you talk to employees and you talk to customers and other evaluation processes, you should be able to determine if this is a bargain sale or trying to get anything out of the business they can, or if this is a legitimate, strong business that is being sold. The current physical condition of the business, from its location to its inventory to other aspects of the physical part of the business, are the assets still valuable? Because all your assets, whether it's automobiles and for delivery or inventory, there's some companies that still have inventory on the books from 10 years ago, and they haven't written it off, and so they're claiming it. And if you're buying the business without discounting that significantly, you're overpaying for the business. The issue of employees, just to move down the list, how many employees will remain? I recommend that if you're buying the business, part of the due diligence of the transfer and buyout process is an interview with every employee to decide whether or not you want to keep them. It's a good process because you basically start up the venture where as a new one under you and set it up that way with in a new corporation or a new limited liability corporation than what the previous owners had. And then look at the status of the firm's financial picture. It is important to engage a financial expert when you're doing this because you want to make sure if the company's profitability numbers, revenue numbers are legit. So that because the price is going to be based on those things. How are you going to determine the value of a business? There are experts out there you can hire, accountants and other business experts that do this for a living. But some of the things you need to do yourself are spend time in the trenches, go work the business, observe, talk to people, talk to customers, talk to employees, talk to the banks they do business with. You want to create a sound business plan for your takeover of that business. That's a really good recommendation so that you have a plan from day one. Secure working capital and backup resources so that sometimes when you take over a venture, a business, you have some drop off in customers because those customers were loyal to the previous owners, and it kind of gives them an excuse to go shop for other vendors. And they were so loyal they didn't do that, and now they're out there shopping on price. And so you need to be careful about assuming that all your customers will carry over with you. Part of your transfer process of taking over business should be meeting with all your key customers and securing them in one way, shape, or form. Look for ventures that have a strong brand and strong image out in the community. I think because that has a lot of value. That trust, that integrity base, those types of things. Keep accurate and complete records and always look at how do I make a profit. And when you're buying an existing venture and if you're paying a good price for it, the the profitability of that venture should be done very soon. I mean, you shouldn't have to wait 3 years to make a profit if you're buying an existing venture. Some do's and don'ts. You should have a seller retain a minority interest in the business if at all possible. And what we call those are earnouts. So say you sell the business, you buy the business for $1 million. The seller gets $500,000 up front, and the other $500,000 is an earnout, say over 3 years or a 5-year period, where they stay working with the business, consulting with the business, and their share of the business, the sale, is based on the performance of the business. So the remaining $500,000 is proportioned out, say over 5 years at $100,000 a year, or is amended based on the performance of the company that year. So their incentive is to not drop off the face of the earth and go away, but to help you secure the customers, find new customers, and transfer some of the goodwill to the new ownership. Never rely on oral statements of sales figures and things like that. Always have things in writing. Always look at written documents, spreadsheets, and other things. Have an accountant examine the books. I mean, it's worth the investment in the accountant to look at income statements, balance sheets, cash flow analysis, those types of things. Investigate, investigate, investigate. It is up to you and whoever you hire to do due diligence on the potential for this venture to be bought. Interview all the employees, as I said before, and know going in what the real reason the company was for sale in the first place. That's all I have for this lecture. Thank you very much.